Hello and welcome to this weekly market recap for the week ending Wednesday, September 10th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's a pleasure to be with all of you this week from a very special location. I am at the Stockcharts.com headquarters. I'm in their studio, and it's a beautiful day here in Redmond, Washington. And again, really a pleasure to be with all of you today. So we had a couple of pieces of really big news today. Number one, we had Oracle coming out with a very, very bullish and rosy forecast for its AI-related part of its business, forecasting $144 billion of estimated revenues for the year 2030. I don't know if they're going to make that. I think it's kind of there's a little bit of irony in there, and I'm going to talk about that a little bit later in the show. And then, of course, we've got the Fed coming up. That starts next week, the Fed meeting. And we had the PPI out for the month of August today, and it showed no inflation. Actually, the headline number and the core PPI number both came in at minus 0.1%, which was 0.4% below the estimate, where analysts were looking for a rise of 0.3%. So that kind of offset the prior month. If you remember, the July PPI came in way above estimates, came in at 0.9% at both the headline and the core level. Both of those numbers were dropped back to 0.7 number on a revision. So we got the big Oracle news that got a lot of the technology-related companies moving today. We had the Fed maybe on watch to lower interest rates after that benign PPI report that was out this morning. So that's kind of the backdrop for today, but let's take a look at what's happened over the course of the last week. So as we look at the major indices, you can see the Nasdaq 100 jumping almost 2% over the course of the last week. S&P 500 gaining more than 1%. Russell 2000 1%, or a little over 1%. Small cap, the mid cap index gaining exactly 1%. And lagging over the course of last week, once again, transportation stocks, which dropped a little bit more than 1%. Now, leading the charge, and of course the reason why we're seeing so much strength in the Nasdaq 100 last week was technology. So we had technology sector up more than 3.33%, communication services gaining over 1.33%, and then also one other sector gaining more than 1% was the industrials, the XLI, which gained a little bit more than 1%. But when you have technology leading, you have communication services leading, that generally means that a lot of other areas are not going to be leading. They're going to be lagging the S&P 500. And I think that's what we're looking at here on the screen. Of course, the three groups that did not perform well over the course of the last week, with growth returning into favor, we had staples dropping 0.8%, financials about 2/3%, and materials a little bit more than 1/4%. So let's pull up that S&P 500 chart and let's see where we stand at the end of Wednesday. And you can see we did have a nice gap up to start the day on Wednesday, set a new all-time record high with the S&P 500 clearing 6550, not far, getting closer and closer to my forecast from back in January of 2025, when I said I thought the S&P 500 would hit 7,000 this year. I think that's where we're going to be toward the end of the year. And we're not that far away, believe it or not, even after seeing a brief cyclical bear market back in the February to April period. Had a very, very strong response off of that April low. That continued today. We saw the gap up. I was a little concerned, though, because we didn't see any real follow through after that opening gap up that was mostly related to Oracle. Actually saw some selling throughout the day. Did pick back up a little bit into the close, but still with some negative divergences. You can see on the S&P 500 chart that PPO has been coming down for quite a while. And we still have the more bearish second half of September that we're staring at. It could be one of these situations, and this is something that I've been cautioning our members about at EarningsBeats. It could be one of these situations where the market is anticipating further rate cuts, to start back up again. But once we actually get the news a lot of times it's that buy on rumor, sell on news type of scenario, and that may still play out this month. So it's nice to see these new all-time highs. It's really nice to see technology and many of the growth names showing some renewed strength. But I do have an interesting RRG chart I'll show you in just a minute that kind of tells me to be a little careful, that maybe this renewed strength and growth might just be temporary. Moving on to the Nasdaq 100, you can see the Nasdaq approaching the high that we saw back in the second week of August. Did not quite set a new all-time high, but we got right up against it before selling off a little bit today, mostly earlier in the day. And like I said, coming back a little bit later in the session. Volume was pretty heavy. And again, kind of makes sense when you think about it. The news on Oracle being a major component within the Nasdaq 100. So I'm not surprised by that increase in volume today, but be careful until we actually get that breakout. The small cap Russell 2000, the IWM, also trending higher, seeing a little bit of relative weakness, as I pointed out at the top of the show. IWM pulling back here over the last couple of days, really struggling to get much follow through. But if you look back at the chart, this 240, 241 area on the IWM, that represented a high from back in November of 2024. And now, just here over the last few days, we've been back up to test that 240 area. So it's not surprising that we would see a little hesitation here, maybe even a little bit of relative weakness in the IWM before possibly making a breakout. And that could come with the Fed announcement. So even though I think we might see a buy on rumor, sell on the news in certain parts of the market, it wouldn't surprise me to see the relative strength of the IWM or small caps that we've enjoyed throughout the month of August and into September. I wouldn't be surprised to see that continue. So that's something to keep in mind. Transportations, the Dow Jones Transportation Average. This one's still a little bit of a problem for the market as far as I'm concerned. I think we're in consolidation mode. We've seen off of the rally from April through July, we've seen price action on the transports go back down below the moving averages and then come back up above the moving averages, and now we're back down below. This kind of waffling around the moving averages tells me that this is more consolidation than it is downtrend. But when the overall major indices continue trending higher, and the S&P 500 is setting new highs, and the transportation index is unable to do so, that is a little bit concerning and maybe a little bit of a warning sign as we try to navigate our way through this somewhat bearish month of September. So again, another area of the market that I'd keep a close eye on, because if we can't see strength in that transportation group in the second half of September, and if we do further weaken, roll over, and go back down toward the earlier lows back in August or early August, I think that could present some problems for the market, at least until we get ourselves into the next earnings season in the middle part of October. All right, I wanted to go over a couple of relative rotation graphs. Of course, my good friend Julius de Kempenaar, founder, creator of the RRGs, I think this is an absolutely genius way to visualize what's taking place in the market. And a lot of times what I like to do is kind of look at how sectors are performing relative to the benchmark S&P 500 on an RRG chart over time. So this is a weekly chart, and I've got all of the sectors on this chart, but I'm highlighting the three aggressive groups. So technology, discretionary and communication services. And I'm starting a year ago, or almost a year ago. And what I want to do is just kind of walk you through these periods over the course of the last year, especially as we moved into January, February of 2025, right before we started into that cyclical bear market that took us into early April. So just kind of keep an eye on these three groups. And what you want to see as I go through here, when the S&P 500 is moving higher, these three groups, you want to see leadership. And so that leading quadrant, which is the upper right-hand part of your screen, that's where you want to see a lot of representation of these three sectors when we are uptrending. And what you're going to see is as we turn lower is these same three groups start to weaken and lead the market to the downside. So I'm going to just drag this through and you can see the strength in the XLY, which is discretionary, and the XLC, which is communication services. And through right now I'm into the early part of 2025, middle of January, and you can see that technology still has kind of been lagging. And if you know anything about the history of the market, you know that technology tends to do its best work starting in about late April and into May, June, July, August. And then that relative strength tends to weaken a bit and other areas of the market tend to carry us in the fourth quarter. So again, let's watch as we go through here. This is to start 2025. Now we're getting to the high. So we're in mid-February, and this is when the market was peaking. Notice we didn't really get much strength in technology leading up to this high. And that was one of the reasons why I was very, very nervous about the market back in February. And then notice as we started to turn down in the market, check out these three groups. Communication services was holding up, but look at technology and consumer discretionary, both moving into that lagging area. And so anytime you see that, that generally is not going to be a good thing for the market. And now we get into the early part of May. We've already bottomed. And check out, I want you to really focus on the XLK because now we're in the month of May. And I know a lot of media headlines talk about go away in May, and I continually say pay no attention to it. This is an area, technology, that tends to do extremely well starting in May. And in fact, if you look back over the last 13 years, throughout this secular bull market, technology has done its best work from May through August. So anyway, here we are in, this is through the early part of May. Watch that XLK start to accelerate. Now we're into improving. This is as we go into early June. And then right about the third, fourth week of June, look at the XLK showing that leadership that it typically shows throughout the summer. And look at it just continue to strengthen. This is all the way through the end of July. And then we move into August. Still got strength in the technology area. Market holds up pretty well. And then we start to see that rotation. And the XLK on a weekly basis just now rotating down into weakening. Now remember, when we look at a weekly RRG, you got to understand that it takes a while for relative weakness to start to kick in. But you can see the XLK turning down out of that leading quadrant, moving down toward weakening. And the other two aggressive areas have already been down through lagging and improving and starting to turn back to the upside, hopefully to take that baton from technology as we move into the month of September and beyond. So that's the weekly look. Let me show you the daily RRG. So this RRG is going to move much quicker. I'm going to fast forward toward the bottom in early April. So here's the S&P as we're getting close to the bottom. Look at technology. And then as we hit that bottom and we start to turn up, now we're in the middle part of April. And you can already see on a daily basis, technology moving into the improving area in the middle part of April. And watch it as we go into May, June, July, and just look at the explosion in the growth-oriented technology sector. This is nothing new for 2025. This is exactly what we have experienced throughout the entire secular bull market. Here we pull back and then we rotate right back up into the leading area. And what's important on an RRG chart, I'm really big into relative strength. Everything, when you're looking at it, everything on the right-hand side of the chart, even if you're in weakening quadrant, what that means is that your momentum is weakening, but you're still on the right side of the chart. So you're still showing relative strength. And really all the way up until we are where we are right now, we have remained over on that right side. And just recently, look at the XLK. That's this yellow line here coming down into the weakening quadrant. This was as of less than a month ago, back in August. And as we've moved into the latter part of August and into the early part of September, you can see that relative weakness that took the XLK into that lagging sector or lagging quadrant. That's typical for this time of year. Now, some that follow our work at EarningsBeats might say, well, you know, when you've got technology lagging and money rotating out of growth, isn't that a sign that maybe we have a bear market coming? Sometimes. You know, there are a lot of other signals in the market. They all need to come together. This would be one thing that I would look for, but you have to understand, historically, this isn't unusual. This is normal for technology to weaken on a relative basis and for other areas of the market to lead into year end. So let's take a look. I wanted to show you the seasonality chart. Here's technology relative to the S&P 500. And look at the summer months. XLK tends to outperform much more often than it underperforms. And if you go down to the bottom, you'll see that the average outperformance over the 4 months from May to August essentially is the majority of technology's outperformance during the entire year. And once you move past August, look at the bottom average relative outperformance. September's negative. October, November, and December are positive, but not nearly as positive as we see over the summer months. So understand history, understand where we are, I think, in this sector rotation cycle, and I think that will help you in the fourth quarter of 2025. I wanted to take you over to my home at EarningsBeats.com. For those of you that are maybe new to the broadcast, welcome. We always love to have new folks in our community here at EarningsBeats. Obviously, those who have been following us at EarningsBeats for a long time, we appreciate your support and loyalty. But if you are new to EarningsBeats, you can come over to our website. We do have a free, no-cost 30-day trial to our paid service. That does require a credit card, but if you just want to learn more about EarningsBeats and what we do, you can scroll down. We do have a free EarningsBeats Digest newsletter that's published twice a week, Mondays and Wednesdays. Schedule's a little off this week as I am, as I said earlier, broadcasting out in the Stockcharts.com studio. So we got a lot of meetings and so forth going on here, which has been great, but we will get back into our regular routine on the EB Digest articles. But make sure you sign up with that or for that with your name, email address. There's no credit card required. Very simple. Tens of thousands of folks have joined us on the EB Digest over the years, so we'd love to have you. But let's get back. I mentioned earlier, and this story kind of fascinates me a little bit because Oracle, their management came out with a very, very rosy forecast yesterday after the closing bell, stating that they believe their AI-related revenues are going to jump to $144 billion for the year 2030. Now, the irony in this forecast is that Oracle just missed their revenue forecast for the last quarter. So management came up short, revenues came up short of Wall Street's forecast based on management guidance in the last quarter, yet the stock went up 40% 36% today on a forecast that goes out 5 years. Doesn't that just seem a little ironic? They can't get their forecast right for last quarter, but the stock gets bid up 36% today because of a forecast for 5 years from now. I don't know. To me, it seemed like a overly bullish reaction. I mean, if you look at where Oracle's revenues are now, $15 billion for the last quarter, which would be on an annualized basis, $60 billion. to go to 144 in AI-related revenues in 5 years doesn't seem that great. I mean, AI is projected to have huge multiples in terms of revenues and earnings and so forth, the growth of those. It doesn't seem like that's a huge number to me when you see where Oracle is now and what's expected from AI over the next 5 years. But yet we saw that kind of reaction. And I bring this up because it seems like a lot of the areas of AI, I'm not going to say they're fully valued because there's a lot of growth ahead. I don't think too many folks would argue with that. But these stocks have all run quite a bit off of the April low. You can see the Oracle chart, which back in April at the low was $120. Today it finished at $328. And I want to show you some of these other large cap AI related names. You're going to know most of these, if not all of these. Nvidia. Nvidia back in April was trading down below $90. It's now $177. And again, I'm not saying yay or nay to any of these stocks. I'm just simply pointing out how far these stocks have gone in just the last 5 months. Next is Microsoft. Of course, Microsoft, the low in April was down at the 350 area, just below. And with its earnings report gapped up to above 550. So another huge move for a company that's already gigantic. I mean, we're not talking about a 60% move in a $300 million market cap company. We're talking about a 60% move in multi-trillion-dollar companies, which is absolutely amazing to me. Anyhow, I just question whether maybe we're fully priced in the near term. So this is Microsoft. How about Apple? Apple is one that I don't think really has seen nearly as much movement to the upside, given that it still is one of the big AI players. Apple, which hit a low back in April, 170, recently hit 240, but did pull back today, back down below the 230 level. Not up nearly as much as some of the others. Google, which I think is one of the best looking charts among the Mag 7 right now. I've been a fan of Google for a little while. I love that breakout above the February high, and it continues to push higher and higher with a very, very strong AD line. Meta had a big move, I think, since earnings again, consolidating, doing a little bit better since earnings than Microsoft, but really unable to push much higher. Palantir, just recently in August, setting a new all-time high, has just had an incredible push to the upside. Pulled back recently, starting to move back to the upside. Maybe, just maybe, we're putting in the right side of a cup on Palantir. And then one of the other really big players is IBM. IBM, kind of like Apple, not really a whole lot of upside since that April move, at least not relative to some of the other big names that I just discussed. And you can see IBM looking like it's failing at the 50-day moving average and near this gap resistance level at about that $260 level. Anyway, those are some of the big AI names I wanted to go over. It really seemed to me like after that news from Oracle, it was more of a gap up and then a lot of selling. We didn't really come back down on all these stocks, but we are well off the earlier highs from today on many of them. So I think it was more of a sell on the news kind of a environment today for many of those AI stocks. And so I wanted to just point that out. And that kind of makes sense of what I would expect going into the second half of September and maybe into the early part of Q4. Some of these growth-oriented AI names have run a lot. I expect more consolidation than I do advance, but we'll see whether or not that proves to be true. But I mentioned Oracle. Oracle missing its earnings or matching its earnings estimate, missing its revenue estimate, and going up 36%. Now I want to show you Rubrik. Rubrik was expected to come in with $282 million in revenue. They came in with 310. Rubrik also was expected to have earnings per share of minus 33 cents. Instead, minus 3 cents. A huge beat on earnings, a huge beat on revenues. They raised their guidance for next quarter, and the stock was down 18%. Now, I can, throw up a quick annotation here. I want you to look at where Rubrik broke out from. It topped in February and then back in May, broke out above the $80 level. After reaching a high back in June, you can see it's been going through this sideways consolidation. Today's big sell-off after earnings came all the way back down, essentially to test this $80 level. I'm going to be watching Rubrik here in the near term to see whether or not we hold on here. If we can get some sort of reversing candle, I do think Rubrik could be set up maybe for another push back to the upside. I actually think even though the reaction was so negative on Rubrik, I would be more inclined to buy Rubrik, which I did today, than to buy Oracle. I personally think there's a lot more downside in the near term possible for Oracle. With Rubrik, we'll see whether or not support holds, but at least we do have that short-term support level to watch here over the next day or two. One other stock that came out with some pretty rough earnings news was Synopsys, SNPS. Big gap down. You can see the stock dropping more than 35, almost 36%. So it was the exact opposite of what we saw with Oracle. And you can see not only did we gap down, but we also had a lot of selling intraday, big red filled candle, similar to what we saw with Rubrik. So there was a lot of apparent distribution in the stock. Wanted to point that one out because it did take such a large hit on Wednesday. All right, to wrap up, what I wanted to do was just point out that there are areas of the market that, we talked about technology not really doing well over the course of maybe the next couple of months on a relative basis and based seasonally. I wanted to pull up the same chart, but this time let's do it for financials. So if we look at the financials and we go back the last 13 years, you can look at the odds of the financials outperforming the S&P 500 over the course of the next 3 months. You can see that the odds really jump. Financials love the fourth quarter. And if you go down here to the bottom and you look at the average outperformance for each of these calendar months, you can see that number too goes up from September to October to November. So we know historically that maybe some of the financials are, these are areas, or this is an area that we should be at least considering in terms of maybe rotating away from some of these technology names. I want to give you 3 stocks that broke out today to 52-week highs within financials that I think look really strong. Would not be surprised to see further gains in the fourth quarter and maybe throughout September, the second half of September, but especially in the fourth quarter as we start getting closer to earnings. The first one is Goldman Sachs. Goldman Sachs here over the last couple of days breaking out to new highs again. Check out the AD line. I think that there's a lot of accumulation that continues to take place on Goldman Sachs. The next one, Morgan Stanley in the same space. Check out that AD line. Check out the candles these last 2 days, setting new highs. On a relative basis, Morgan Stanley, Goldman Sachs showing a lot of relative strength in a group that has been one of the stronger areas in 2025. So I like both of those two. I'll give you a third one in a little different area. This is PennyMac Financial Services, PFSI, massive breakout over the course of the last week, maybe a little longer, taking out recent highs. I didn't like today's candle though. So to me, that is a shooting star type candle or an inverted hammer off of an uptrend. So maybe we get a little bit of a pullback, but notice over the course of the last month or so, that AD line has started to turn up. Relative strength just recently moved to about a 5 or 6 month high. On a relative basis, the mortgage finance area of the market has been showing relative strength. and has moved to a multi-month high relative to the S&P 500. So those are three names I think that could be really interesting in the weeks ahead. Again, first I just want to thank Stockcharts for hosting me this past week. We've had a great week. Love using the studio here, and it's been a pleasure bringing you this weekly recap from their studio. I'll be back next week to do it all again. Keep following what we do at EarningsBeats.com. I do think we're going to see continuing strength into year end. I think short term, I never want to say we're going to be bullish going into the second half of September because those seasonal headwinds are so strong. So be a little careful here over the next couple of weeks. Try to focus on areas that tend to do better this time of the year. Try to stay away from groups that are so overbought. Get some pullbacks, and then I think we'll have some better opportunities ahead. Anyway, have a great week, everybody. And as always, happy trading from Redmond, Washington.